Further ado, let me just talk a little bit about Howard Getson. So when the ordinary investor hears the word hedge fund, they think automatically, oh my God, they're risky. Or they're some part, a secret, mysterious part of the investment community, when actually the opposite is true. And yet some people feel hedge funds are a surefire way to make a lot of money. The man that knows the answer to what hedge funds are is our next guest to clarify the confusion and make things clear for you. His name is Howard Getson. He is the founder of Capitalogix, where he uses, which is super, super interesting, artificial intelligence so effectively to help guide his clients in the decision-making project inside of the hedge fund space. Now, I can tell you that he's got an MBA and a law degree and has been successful in business, but the thing, most important thing you need to know about Howard is he knows how to make good decisions based on facts and information, not on emotion. If hedge funds are in your future, the man you want to know is Howard Getson. Please help me welcome Howard. Howard, how are you?
Hey, how are you?
I'm excellent.
So I was listening to that and I wrote down a bunch of notes. And if you don't mind, I was going to tell a story, but instead I want to deal with some of these things just because it's right after you talked about them.
Absolutely. I mean, I'm here. You're my industry guy, and I probably, asked more questions than I gave answers, and this is what your time is for.
Well, the first thing you mentioned was Madoff, and I think Madoff actually had an incredible impact on funds. I was a corporate securities lawyer back in the 80s and 90s. And in a sense, I know how funds used to be run. But I also run a fund now, and I will tell you that the regulation and the scrutiny has become radically different, not just because of the regulators, but because the public has gotten so much smarter about doing the due diligence on the managers to make sure that the alpha you expect is the alpha you get. And I know that you've already talked about the concept of alpha, but I just want to define alpha for people the way I understand it, at least in our own company. To me, alpha represents the excess return based on the manager's skill, as opposed to beta, which is the portion of the return based on the amount of risk you're taking or the underlying movement of the assets. So a rising tide floats all boats. You have to find a way to detrend that information out to figure out, did somebody get lucky or skillful? And alpha is supposedly the measure of skill. And a skillful manager can tell you what their alpha is, but more importantly, they can tell you how much it costs to generate $1 of alpha. And at least in a fund like ours, we can't really afford to pay more than 10 cents to generate $1 of alpha, because most of the gains go to the client, not the business. So that's just an interesting kind of side note, is you can think of a hedge fund as a manufacturing facility that's supposed to produce alpha. And you're, in a sense, selling the excess alpha for a share of the profit. So Madoff actually dramatically changed things, but increased the cost of running a hedge fund, because we now have a third-party administrator who's marking the trades to market every day, which means they're looking at our bank balance, the trading account balance, as well as the trades we send to the broker, and in a sense certifying to people that those trades were made. That's something that Madoff said that they were making trades, but they weren't. Another thing we've had to do is we've hired an outside compliance firm who's got regulators, accountants. They do the books of the regulated entity separate from the audit. There's a fund audit. There's also a company audit. And this is now necessary because smart, rich family offices have figured out I'd rather measure twice and cut once rather than be tricked by something that seems too good to be true. So Madoff has actually had a very interesting effect where it's shined a light on the cockroaches, and a lot of people have scurried away because there's so much more scrutiny, but it's also so much more expensive to run a fund. And that's part of the reason people are paying for a hedge fund, is that they now actually do believe that if it's done right, that they have transparency, and what once was a black box is no longer black to the investor. It requires a lot more transparency than ever before. The regulation has also dramatically changed, and it becomes a lot more important for a fund like ours to understand who our clients are and to make sure that there's no money laundering, know your client. It's just become radically different even in the last 5 years or so.
How do you answer the performance issue? I mean, the big question I always get is the fee structure inside of hedge funds is. Can you talk about the fee structure
Absolutely.
and sort of the lack of the
Sure.
lack of performance? Because I mean, is it industry standard that a hedge fund fee is typically 2% of assets and then 20% of the profits? Is that?
I think that was the standard. What we've seen recently is it's probably dropped to 1.75 and 17.5 instead of 2 and 20. Doesn't seem like a big difference, but it's a difference. However, what we're seeing is the most successful managers are now actually charging more. And they might say, okay, we'll charge less until we hit this hurdle rate, and then above that rate, we'll charge more. And but that's only for the kind of funds that people really want to get into. By the way, when you talk about Buffett's bet from 09 to 19, those 10 years, those were the best 10 years in the S&P history. A hedge fund, most of them are not trying to index the S&P. They're trying to actually have returns that are decorrelated from the S&P. And so in years where the S&P dramatically overperforms, for example, in an absolute return fund, you're probably going to underperform the S&P a number of those years, but it's by design because you want to be decorrelated to the underlying markets, but you also want to be decorrelated to the beta. It's called beta neutral. And so in a sense, you're not relying on getting lucky that the markets are going up and down. You're making money in some other way. Our flagship product that we're not really talking about tonight, but it's a market neutral, beta neutral product that's designed to make a fixed amount per month, kind of regardless of what happens in the underlying markets, because it's not trying to make it from the S&P or from gold or crude oil. It's looking at 20 some major markets, and it's basically saying I'd rather be in cash if I don't know what my edge is. And frankly, that brings me to a really important point. If you were to look at the list of the 25 most successful or highest paid hedge fund managers in any year, you'd see names like George Soros, Ray Dalio, Jim Simons with Renaissance. And the thing is, from year to year, we've done research, and only about 8 names from one year make it to the next year. It's not like these guys get dumb. What happens is the style of trading that this firm or that firm has goes in and out of style. And so what you'll find is that global macro does well some years. Value investing does well. Statistical arbitrage, reversion to the mean. There's so many different styles or ways of somebody saying, here's what my edge is. But over time, if you look at this over a long enough period of time, you'll see the same name show up again and again and again, because they really are skillful. They're just skillful at something. And back in the old days, people didn't want to have a strategy that mixed too many things, because people were buying exposure not only to alternative asset classes, but a specific type of investment technique. So in a sense, you can have diversification based on assets, techniques, timeframes, how you make money, when you lose money. You want to be decorrelated a lot of ways to make sure there's more ways to win. But that actually leads to one of the biggest ahas I had, and it happened to me in 2008. I remember in 2008 having one of the worst days of my trading career and thinking, if we're so smart, how could we lose so much money? And then it occurred to me, I was trying to predict what the best thing would be. But on the day that so many people lost money, I remember trying to tell my wife, oh my God, it was one of the worst days ever in the market. And as I said it, as I was saying it, I remember thinking, but that's not true. I wasn't lying to my wife. It was one of my worst days ever in the market. But trading is a zero-sum game, and somebody made that money. And it really gave me an epiphany. It was, instead of predicting markets, if you had enough data and you could figure out who's making money in each of the trading pits around the world, somebody was cleaning up. What if you could figure that out and follow quickly? In a sense, that's what's happening with AI or machine learning now in trading. People are using data for an asymmetric advantage. It's actually been happening forever. In the old days, if you think about Wall Street, the market itself is a place where you can see the collective fear and greed of populations, right? I mean, people used to come there so that you could watch people buy and sell. And it's one thing for somebody to say, I believe in gold. It's another to watch them bet with real money and say, I'm buying this many contracts or, this much gold. And then people paid for a seat at the exchange because if a local was buying or selling a stock or some gold, maybe it represented whatever they were buying or selling. But if you saw Goldman Sachs do it, they're not going to buy 10 contracts because they're buying 10 contracts. They're buying 10 contracts because you thought they were getting ready for a much bigger trade. And so in a sense, the seat at the exchange was a way to have an asymmetric information advantage. And in a sense, that's what people are trying to pay for in a hedge fund. Sometimes they get it, sometimes they don't. But what they're paying for is the sense that it's expensive to do enough research, to have the right kind of computers, to be able to process the information correctly and fast enough so that the edge is still valuable before it decays. And if you don't get it, if the hedge fund isn't successful, then it doesn't make any sense to pay for. But there are some hedge funds, and I won't talk about mine, I'll talk about somebody like Jim Simons with Renaissance. His medallion fund is legendary. It's returned way more than the S&P by multiples over a much longer period of time. The problem is, I don't care how rich you are, you can't get into a fund like that. Now, they have other funds you can get into, but it's not the medallion fund.
Well, so, speak to that, Howard. I mean, if somebody wants to, they watch this program and they're like, I want to think about hedge funds, I guess they could go to their investment guy. Is there a central database where you find the various managers? I mean, you bring up a great point about access.
Yeah, I mean, in a sense, hedge funds there's a cost, but there's also access. And you don't want to just get into a good brand because you heard it's a good brand. You actually, do you remember when Fidelity Magellan first got really famous? Peter Lynch was the manager, right? Fidelity Magellan was just one of Fidelity's funds, but Magellan was that flagship, and then it was taken over by somebody else. But you were really investing in the manager. You thought that he had access to deals or information. I mean, that's what it was a long time ago. So many of these funds have many different products. I guess what I would say is, most of the really rich entrepreneurs I know now have a business manager or a wealth manager who helps them dot the I's, cross the T's, and ask questions that they wouldn't ordinarily know. The way I've seen it happen, the entrepreneur, the guy with money, or the lady with money, the person with money, is pretty good at recognizing talent and opportunity. But on the other hand, they're a big picture person and they're saying this is interesting. And then they rely on somebody with specific industry knowledge to make the finer distinctions. And the way I look at it is the advisor can't say yes, but the advisor can kill the deal in an elevator by simply saying, no, they don't understand. But advisors are incredibly important because I don't think a hedge fund is something somebody should buy on a whim. It's an important investment. Maybe it's only 10%, 15% of somebody's net worth, but it really does represent a very different asset stream. You said that they're illiquid. Some hedge funds are illiquid, especially if they're investing in things like art or things that aren't freely marketable. But a hedge fund that's trading, for example, electronic futures, you can buy or sell electronic futures even easier than stock because you can simply go short. There's not even an uptick rule. So hedge funds don't have to be illiquid. One thing that might make them seem illiquid is that a mutual fund marks to market every day. And in a sense, you can get in or out at 4 p.m. every day. But in a hedge fund, there's typically a lockup that says you can only get out once a quarter or even once a year. I guess in some sense that makes them illiquid. But in terms of being able to value or understand, I think most hedge funds are now pretty liquid simply because the increasing noise and volatility of the markets have made it so that the managers want that liquidity because they don't want to get stuck in a position that's going to impact their record and make it hard for them to hit their hurdle rates or make their fees. The other thing is survivor bias. You have the exact same survivor bias in the S&P. If you look at the S&P 500 and you tried to figure out how many companies used to be there that aren't there, you'll see the same thing. But it is true. A ton of hedge funds go out of business and a ton of mutual funds go out of business. I think you said something that really is very true. And I really think you have to understand the edge you're looking to buy or acquire with a hedge fund. I don't think you have to understand the specifics. I mean, in our company, we use AI, and I don't have a PhD. We've got dozens of people with PhDs, quants, rocket scientists, but I understand the theory in general. I understand the edge, but I couldn't tell you why something is making a trade at any moment in time because we've actually gotten beyond human logic. It's making decisions at light speed. I think the same is true for an investor. You have to understand how it adds something to your portfolio. And it might, you know what I think it adds? I think that in the old days, diversification used to come from having exposure to different asset classes. And so in a sense, somebody said, I want some blue chips, I want some consumer cyclicals, let's get some high growth tech stocks. You know, I remember back in the early 2000s, I thought of the 1 to 3 letter stocks, the things on the Dow, as boring. But the 4-letter stocks, the NASDAQ stocks, boy, that's where you could make some money in the internet days. And I didn't want to have too many of the boring stocks because I wanted that juice. Obviously, we don't trade like that anymore. But in a sense, what I'm saying is diversification used to be about having exposure to different asset classes. And let me tell you something that I think is really important as a distinction that we now make. To me, diversification now happens at the choice level. And that means I want even more choices. But technology is so fast and we have access to so much information that we can concentrate our bets and then pull back to cash, concentrate our bets. So we have exposure to all those different asset classes, all these different techniques, the different risk levels, the different allocation strategies, but in a dynamic and adaptive way that's using real-time contextual information to say, if you don't know what your edge is, you really don't have one. And simply diversifying so that you can say something worked every day is really saying the opposite. You're saying I'm willing for a ton of my things not to work every day. But data and technology is now getting to the point where if you can afford the right tools, you actually could invest with a manager who believes that they can watch what's making money in real time. And in a sense, in my business, one of the fundamental precepts is don't pay attention to all the things that are changing. The best businesses focus on the things that don't change. And as a hedge fund manager, the thing that won't change for me is how to measure what's adding value in our business. So the markets are going to change. The algorithms are going to change because technology is constantly changing. They're not as important as they used to be. 5 years ago, algorithms were magic. Now they're something that computers can generate thousands and thousands of. But the logic,
it's a really good. I mean, it's an interesting perspective, Howard. We're gonna need to.
On time. I got one more thing I need to add there for you and your guests.
Sure.
Is years ago, algorithms were the key. I actually believe data is becoming more and more the key. If you have the same information and the same process as somebody else, you can't have an edge. In a sense, that's not alpha. A lot of people are saying, oh, my edge is I use computers differently, or look at our algorithm, it's better. I actually believe that in the next couple of years, what you're going to see is alternative data. Getting data from other sources is going to be the new generation or the new source of alpha. And you're going to see people using satellite imagery. They're going to count cars in parking lots or ships in the ocean. They'll be able to measure crops that way, but they're also going to use things like credit card declines and all the internet data that's available. It's a fascinating new world, and you're going to find lots of new ways to generate alpha with data.
Awesome. Well, hey, I really appreciate your time. I could sit here and talk to you for much longer, but we got to move on. Howard, thank you for your time.
As I promised, I'm going to offer your Sustainable Family Wealth Summit free access to our newsletter. Normally, it's only for clients, but if they simply dial text 972-992-1100 and type the SFW Summit. So again, text 972-992-1100, and the text is SFW Summit. They'll get free access to our weekly commentary, as long as our weekly curated list of links, which talks about technology, AI, and the markets. I think it's fascinating, and it's a gift for you. So I hope your team likes that.
All right, Howard, thank you. And thank you for being here. Now we're